The roadside real estate business has released its interim results. To go through them and look at the wider picture, I'm delighted to be joined by the chairman, Charles Dixon. So, Charles, the plan is to develop and sell real estate sites that comprise food convenience stores, electric vehicle recharging points. Ideally, it's not to own, but you do own sites in Wellingborough and Malden. Are you happy to continue to be landlords, as it were?
Absolutely. I mean, we continue to own those in the PLC, and we are looking to continue to own these sites in the joint venture we've got with Meadow Partners. So we're definitely not sellers, and I think it's really important to clarify that. And so thank you for asking that, Sarah. But we are buyers and developers, but we are long-term holders of this asset class. We believe that it will outperform in terms of values and rental growth.
So therefore, do I now reference you as an asset manager?
Yes, we're both an owner and an asset manager, because we have a asset management business that manages our joint venture with Meadow Partners, but we also own we own directly our own property, and we also own a share of the joint venture with Meadow Partners. So we're doing it all basically, and we're looking to continue to grow and continue to scale up and own as much as we can.
Charles, from speaking to you beforehand and what's in today's release, you have this stated ambition to grow a portfolio of £250 million of a roadside real estate. You know, how is that going? How are you finding market conditions?
Great question, Sarah. We signed the joint venture with Meadow to deploy 250 million in a portfolio of roadside real estate assets last October. We've made our first 3 acquisitions, which total around 15 million of committed capital. We have an imminent pipeline in excess of 100 million, well in excess of 100 million, and we are well on track for hitting the metrics of that business plan. We're finding market conditions favourable. There's no depth in the market. There's not a lot of people buying at the moment. So it's a very good opportunity. It's a very good buying window. We're lucky to be liquid and have the ability to be able to do that.
So in terms of those metrics and the business plan, how quickly can shareholders start to see returns?
So we've got a 3-year business plan. We've got a 30-month deployment window. There's a 3-year business plan when we buy an asset. So I'd like to think we'll start getting returns over the next 2 to 3 years, and very good returns. So that's the sort of timelines we're looking at.
So you're transitioning to become pure roadside real estate, because you've still got your Barkby pubs. I know you're disposing of them, but is now the best time to be really selling pubs? You know, how will you ensure that you get top dollar?
Good question again. We sold 5 last year. Of the 9, we've got 4 left, which are expected to be sold over the next week or 2. We're actually retaining, of the 4 that are left, we're retaining the freehold and renting it out. So we're not actually selling the freehold of one of them, and the other 3 are leasehold. So listen, the hospitality sector has had a really, really tough 4 or 5 years. It had COVID, then it's had inflation and cost of living. It's not a great time to be a pub operator. We made the call to come out of pubs 18 months, 2 years ago. I'm very pleased we did. I think if you look across the sector right now, there's no one hitting it out of the park.
Let's have a look at another element of your portfolio, Cambridge Sleep Science or CSS. It's an interesting part of the portfolio. No, it has given you significant liquidity events through a stake sale. I'm just wondering if it's the gift that's going to keep on giving. You own 61% of it. You know, what's the plan? How important is it for revenue generation?
I think it's it's been an incredible success story. We made the investment 4 years ago. We invested around 3 million over the space of 2 to 3 years. We've already had our investment out, and more. We still own 61% of the business. We're very, very committed to the business and its trajectory, which is significant. We're not reliant on it for revenue generation. We're looking to maximize shareholder value. We are holding it as a discontinued operation and looking to as I say, realise maximum value for shareholders over the next year or so. I think there's a number of options for that 61% stake, and we look forward to updating shareholders as we move through the process.
Well, as it stands, and looking through your release, you have net cash of £5 million. And in terms of your ambition, it doesn't sound a lot at all. I'm just wondering how dependent Roadside is on its working capital facility, and how will this be repaid if it's drawn?
It's not really dependent on it at all. I mean, we're moving into cash generation in terms of CSS, but also our two properties are generating cash. We've got a very low overhead. We've signed our joint venture with Meadow Partners, and we own 51% of the asset manager. That's now generating cash as well. Meadow Partners are putting up 97% of the capital of every site we buy. So there's not big cash calls on the PLC. So I'm optimistic about the next few years. Obviously, if we want to grow this into the business we want to grow it into, then we will need more cash, but we've got the ability to sell down more of Cambridge Sleep Sciences. We have the cash generation of our Roadside business, but also of that business as well. So we're not looking at taking on any additional borrowings.
Talk to me about the net asset value of what you have or what you have under offer, and how excited should investors be about your NAV or net asset value?
Listen, I think NAV's always an important thing. You know, if you had to sell everything, you know, how much am I going to get back as a shareholder? Our stake in Cambridge Sleep Sciences off the last investment is worth north of 45 million. We've got over 10 million of investment property on balance sheet. We've got around 18 million of net debt. So we've got a significant net asset value within the company, albeit because Cambridge is still 61% owned by the PLC, we can't recognise the value of that investment. So no, we are in very much a very positive net asset value position. I'm not sure our share price reflects that.
That's what I was going to ask you. Does the share price reflect your NAV? And if not, why not? Is it all down to market conditions in terms of equity trading market conditions?
I think it's very easy to blame market conditions. I think that's sort of the easy way out. I think it's more important to educate investors on the opportunity. You know, we only did the deal with Cambridge Sleep Sciences in April, so it's only been a couple of months. So that, you know, that's one of the reasons I'm talking to you, Sarah, is we're looking to educate investors on the opportunity, and there is a significant opportunity in this business, not just on a NAV basis, on a going forward basis. You know, we don't believe Cambridge Sleep Sciences will be worth £75 million forever. We think it'll be worth a lot more. Conversely, we also believe our Roadside Real Estate business is going to become hugely valuable over the next couple of years.
Very good, and we'll leave it there. Charles Dixon, Chairman of Roadside Real Estate, thank you very much.
Thanks, Sarah. Thank you very much.